All right. So today, let's just start up where we left off. So vouchers payable documents. So these are documents that we have to make a payment. Part of cash is how to get cash out of a company. And one of the ways people get cash out of a company is through the accounts payable. Accounts payable gets paid off. Could be a fictitious. I'm going to bring in a different stamp for this. It could be a fictitious account. It could be whatever it is. But you're always on the lookout for how to get money out of a company, and one of the ways is through accounts payable. So how do we keep that from happening? Well, we keep it from happening like this. There are 3 documents you have to have for a vouchers payable to be paid. First one is a purchase order. And a purchase order is just a document that purchase order is a document that confirms that an item was ordered. So if you want to order something in a company, you have to have a reason to do it, and a purchase order will spell out who's ordering it, why they're ordering it. The purchasing department will set up who they buy it from. They might get bids for it, depending if it's not a normal item. They have to get competitive bids for it. And anyway, it's a way to document that something has been ordered. So that gets sent to a vendor. Vendor sends over something, and we get a receiving report. Oops. So somewhere they'll have in a loading dock, they'll unload the truck. And create receiving report. What was received? And lastly, we will get the vendor's invoice. Whoever sold it to us will get their invoice. And the vendor's invoice will have the prices should match a purchase order. And the quantity should match the receiving report. So we get the vendor's invoice, and maybe we ordered 10 things, they sent 8. Whatever price that we agreed upon, that should be the price that we pay. So, if they only sent 8, then the quantity on the invoice should say 8. So all 3 of these have to be present before a check is cut. And so these are kind of the vouchers payable documents, or accounts payable. They do the same thing. Accounts payable and vouchers payable are pretty much the same thing. There's a little bit of difference, but the only thing that's different is that accounts payable, technically they just take all 3 of those documents, they cancel them, so they can't be used again. So the invoice can't be used again. The purchase order can't be used again. The receiving report can't be used again. So they can't, to make sure they're not double billed. They probably do that electronically more nowadays than anything. But so those will all be canceled, so they can't be built in, and they authorize the check to be cut at that point in time. Vouchers payable is very similar in that it takes all three of those documents, puts them in, approves them, cancels them, and then puts them into a vouchers payable, and the vouchers payable is then paid. So it's not that big of a difference between those two. It's just kind of a timing difference. But vouchers payable means that all three of those documents have been put together. But either way, you have to have all three of those to make a payment. And sometimes you hear about people that will send just random invoices to companies. And if they send out 500 invoices and one company pays, they get a check for $3,000 or something. So it's important that they kind of do these things. Okay, lapping. Lapping. Oops. Hey, it is doing something funny here. Okay, lapping. What's lapping? Lapping is when a customer's account is stolen, or a customer's payment is stolen, and subsequent customer payments are used to cover up the theft. Okay. So let's see what we mean by that. I gotta move some. Oh, yeah, move for me. Yay. Okay. So customer payments. So this is often happens when there is but when incompatible duties are combined. For instance, if you give checks to the accounts receivable clerk, the accounts receivable clerk could set up an account and to take one of those checks and to keep it and then write off the account or something like that. But it could also be used in a lapping example like we're going to have here. And here's how it works. Suppose we have like a $4,000 check and it's made to the Bedrock Corporation from Fred. We apply all of it to Fred's account because it's made to the Bedrock Corporation. Okay, so that's a pretty easy one. Now we go to Wilma and the check is made to cash, which means what? You got a check made out to cash. Means anyone can cash it. So we find out that the accounts receivable clerk is a compulsive gambler. And so you can probably guess what happens next to the check. Oops. So the compulsive gambler takes the check for $5,000. Now notice there's nothing to apply to the account of Wilma. Okay, so now what's the problem?
There's a $5,000 discrepancy.
Yeah, Wilma's going to say, "Hey, I just paid this. Here's the check. I got the canceled check. I already paid this." So what the clerk does is say, "Okay, well, I got this $8,000 check from Barney. I got to get Wilma off my back. So I'm going to take 5,000 from Barney's check." That's right. Okay, so I don't know why they make these arrows light blue that no one can see. That's the default color. All right, color. Let's make it red. How about maybe make it a little thicker? Okay, so we got to get Wilma offer back. So we get our Wilma offer back, and we give $5,000 to Wilma. Now, we don't have 8,000 to put in Barney's account, but we do have 3,000. So we'll put 3,000 in Barney's account. So that 8,000 be split up between Wilma and Barney. So now we got Wilma offer back. But we still got a problem. Now we got Barney on our back. Barney just put in a check for 8,000 and only 3,000 has gone to Barney's account. But just in the nick of time, Betty deposits $6,000. Okay, so oops. We take Betty's deposit and we split that up. So Betty's going to give 5,000. Oops, is that too far off? Hello. Let's get these a little closer. Oh, you know what, you guys, give me 1 second. You guys the handouts. Yeah, if you don't have them already. Oh. Yeah, if you do mind. Okay, so now we got Barney is off our backs, but now we still got Betty, and we're nothing we can do for Betty right now, but it's near the end of the month, so hopefully Betty doesn't. If Betty does complain, we'll say, well, we just didn't get the check in there yet. You know, it'll if it doesn't go through, if it doesn't show up in the next couple of weeks or so, let us know and we'll take a look at it. So this is lapping. When you take future and you say, well, that looks like a mess and that looks like a real pain. Yeah, it is. That's why people who do lapping never go on vacation. You know, they fly out to Vegas on Friday and they come back on Sunday. Because they can't miss work because they have to keep doing this kind of stuff to cover it. Okay. Which one of the number 4? Which one of these are? This is on page. What page is this on? 3, 4. Which of the following ways to detect lapping? There's actually 2 of them on here.
Option C.
A and C.
A was certainly a good one. Check the daily the checklist total with credits to the accounts receivable journal. Okay, so oops. Yeah. Okay, so this was one that you definitely have.
And C.
Yep. C. These should be entered intact, and so I'll tell you what I mean by that. Don't do that. I like it better when Word wasn't helpful. All right, so if you have an $8,000 deposit, if you have an $8,000 check, this should generally go in as one item. that should go in intact. You should be able to look through the customer accounts and see an 8,000 one. So for all of these amounts that are written in these checks, these should all be, intact. In other words, you don't have a split between 5,000 and 3,000. You should be able to click on it and find an 8,000. And if you don't find it, that is possibility that there is a laughing. Now, if this clerk goes to Vegas and wins it big and comes back and has the discipline to pay it back, you might never find this. No one's going to complain. All the money will be there, but if you know anything about gamblers, it's probably unlikely, but it could definitely happen. And you say, well, how often does that happen? You don't know, because it could be happening. Questions? Okay. A lot of stuff you guys are already familiar with. Electronic funds transfer. This is obviously makes a lot of the stuff less likely to happen. For instance, a lot of these checks that have come in, electronic transfer kind of puts an end to that. And this is obviously just payments and receipts of money being transmitted electronically. And this has actually done away with a whole lot of different kinds of frauds that we have. Not completely, but a number of them. Okay, year-end bank statement. This is just usually just a regular old bank statement. However, for auditing, we have the year-end bank statement is sent directly to the auditors. So the year-end bank statement is sent directly to the auditors, and this is one thing you work out with the client. You tell them, okay, and it's a very common thing to have happen. That the bank will send the auditors directly the bank statement. They will not take the bank statement from the client.
Professor, on my handout, it has H as standard bank confirmation form.
I think I moved that. Maybe you may have. Did you print it out early?
Yeah, I did.
Okay, it looks like this. Yeah.
Yeah. Okay.
Okay. Yeah, it'll be. I moved them around a little bit, and I apologize.
Okay. No problem.
Every time I teach a class, I redo stuff. Even when I tell myself don't redo it, I do it. I don't know why. It's a bad habit. Okay. So your bank statement is sent directly to the auditors. Okay, let me kind of explain why we do this. The reason we do this is to get better evidence. Okay, so our best evidence is when it is held by a third party and created by a third party. So it's not the client, it's some third party, and it's created by the third party. It could be something like a lawyer. A lawyer the client's lawyer gives us a letter held by the third party, and it's sent directly to us. The medium evidence is held by the client and created by a third party. And to fill us out, let me give you the worst evidence. The worst evidence is created by the client and held by the client. They can make up anything. So a bank statement sent to the client would be medium evidence, but we want to make it into better evidence. So what we do is we have the third party, the bank, send it directly to us, and that moves it, the bank statement from being medium evidence up to. So we're always trying, if you can improve the evidence, that's kind of what this is. Is that showing up backwards, or is that does it show up backwards on the?
No, it's the right side.
Okay, it's backwards on my screen. But that's okay, because I can read backwards. All right. So that's done to make it better evidence. Cutoff bank statement is also sent directly to the auditor. This one is a little bit different than the other one, though. Okay, so the cutoff bank statement is usually I think I don't know how to say this. Up to 14 days, say, after year end. Oops. Example. Bank statement on 1/10. Oops. Well, let's say 2024. Let's go into the future. Okay, so let me highlight these. So we might get a bank statement. It could be up to like a couple weeks into the next year. It's a cutoff bank statement. And the reason we get the cutoff bank statement is because of a couple things. It can actually help us with a number of different things. One of the things it can help us with is looking for unrecorded liabilities. Suppose the client gets a bill, and instead of putting it in the system, they put it in the drawer and they lock the drawer. How do we find it? Well, one way to find it is that they might pay it when it's due at the end, going into the beginning of the next year. And so if you see a payment, any payment made in the first couple of weeks of the year is probably accounts payable at year end. It may not be, but you can look into them and make sure that all those that were paid were on the books at year end. Question on that? You can also look at things like on the bank reconciliations and stuff like that to see if they match up. But the cutoff bank statement is actually a really good one. You can actually do a lot of things with it, and we'll actually talk about it more later on in chapter 16. Okay, bank reconciliation. This is probably the most important internal control for a company. It's I think the only one that is required, basically for legally required to hold banks liable for some frauds. is considered a basic business procedure that is required basically by all companies, or else they can't hold the bank accountable for fraudulent checks written on their account. Okay, so what do I mean by that? Okay, so if somebody was taking checks from the client and fictitiously writing amounts in, signing them, and paying them, the bank is only required if you're doing a if you're not doing a bank reconciliation, the bank is only required to pay the first month's worth. Bless you. The idea being is if you did a bank reconciliation, you would have found this, and the bank is not liable for anything after that. So if this goes on for 24 months, the bank's liable for the first month. And if you're not doing a bank reconciliation, the next 23 months are on you. So it's a required document, and in business, it's one of those things you always look to make sure that they are doing, because it's a basic control. It's so basic it's required by courts, whereas other controls are not. Okay, so bank reconciliation. Bank reconciliation is necessary to one thing is to correct the cash balance. Oops, and two, to learn how to better space a handout. Two, to detect fraudulent activities. Okay. So bank reconciliation. Find the correct balance at the year end. Another thing, yeah. So another thing too, though, when you're looking at it, it's kind of covering things up. When you're good, it's not just that it's a good control. It also is necessary to find the correct cash balance. So the correct cash balance is usually required, to have when you're doing your financial statements, especially at year end. Okay, well, let's stop talking about bank reconciliations and let's do one. Okay, so this is like a page. Oh, by the way, and I'll show you kind of what the difference between what the book has and what I have, and I'll explain why they're basically the same thing. It's they're showing the proof of cash, which is just I'll show you when we get to it. Okay, bank balance. So here we have a bank balance on January 31st of 2,400. So we'll put that in here. And the book balance is 1950. If I had been smart, I would have made that into 2 columns so I could put them, I probably still can. Oops. Why is it doing that? Oh, all right. So what we have is we have all this stuff down here. So these are all the things these are the adjustments we're going to need to make. Now, there's some things that the bank knows that we don't know, and there's some things we know that the bank doesn't know. And we always try to correct the other side. Whatever side doesn't know, we correct their side. Okay, first one is a deposit in transit. So a deposit in transit, that is when you make a deposit near the end of the month and it's not available in the bank. So you make the deposit, let's say you make the deposit on January 31st. The bank doesn't recognize it that day. They recognize it in going into the next month, going into February, whatever. So we know we made the deposit, the bank just doesn't know. So whose side do we correct? The bank side or the book side?
The book side, because we can't correct the bank side.
Well, we're not, well, we certainly can't do the journal entries, but we're, as far as who knows, we know that we made the deposit in transit. The bank just doesn't know. So we're going to add this to the bank side. They don't know. And yeah, we can't just go into the, and it makes some adjustments on this account. I don't like it. But we will make adjustments in ours. So this deposit in transit. So we made this deposit in transit. The bank just hasn't recognized it yet. So the bank side should be 515,000, no, $515, I should say, added to it. Okay, EFT, these are electronic fund payments. Now, here's the thing on businesses if they're using a checkbook. These electronic fund payments and receipts will not be in there. There are no checks for these.
It will be
That's on
added.
the book side.
Yep.
It will be the book side because they don't see it.
Yep, yeah, we don't know that, well, I mean, we may know that some of these are there, but there certainly isn't any check for it. Okay, so let's see, we're gonna add the revenues, the receipts. Oops. Darn it. Isn't it fun watching me learn how to use a computer? It makes it all worthwhile. Okay, so looks like we got receipts of $50. And again, there's no check for that. And EFT payments. Were 120.
Funny.
My my handout's a little old. Rent payment is 120. Like when you go to the movies for a quarter. Okay, so again, there's no checks written for these. So if you're doing this off of a checkbook, there aren't any. Okay. So NSF check. Now this is a check that we got from a customer. So we get this check from a customer. We think it's good. Maybe we can check to see if it's good, but we present it to the bank and the bank says there's not enough funds in there. So they take it back out of our account.
It will be in the book balance
Book
as
balance.
a deduct.
Yep, that's absolutely right. So NSF check, we thought it was good. We, deposited it, but it wasn't. So we're going to take it out of our cash balance because it really isn't cash yet. I gotta redo this one. Okay, outstanding checks. when you write a check and stick it in an envelope, does the bank immediately know about it?
No,
No.
No, so it will be in the bank balance as a deduct.
Yes. So we'll go to the bank balance, and so this will be outstanding checks. So these are checks that we've written that just haven't cleared the bank yet. What are they? 800? So we're gonna take 800 out of the, the bank doesn't know about these. We know we did them. The bank doesn't know. Bank fees. And again, this is a no check.
In the book balance.
from the
Correct.
book.
Balance.
Yeah, the bank just takes this money out. We don't write a check for it. So the bank just takes that money out. We're not gonna have a check written for $30. So this will be, what do I call it? Bank fees. $30. Okay, these last two, note collection and interest income. Note collection is the one's a little bit, I don't say unusual. What is a note? A note is similar to, a note similar to a post-dated check. They'll say, okay, we'll pay you in 90 days or whatever. The difference is it usually has interest attached to it. So they'll say, we'll pay you some interest, but you won't be paid for 90 days or whatever it is. It's like a check in that whenever you sign it, it is a promise at that point that you will honor it. So it's very similar to a check. It's sort of like a post-dated check. Now, if you're in business and you're not used to collecting these, you say, okay, well, who collects checks? Well, the bank does. So you may have the bank collect that for you. They'll probably charge you a fee for it, but note collection would be something that the bank could do for you. All right. You would probably find that out on the bank statement. So whose side are we going to?
Book balance as an addition.
Yep. Note collection 500. And interest income, you're probably going to find that on the bank statement also.
Book balance.
Yep, good. Okay, now. Got a whole lot of extra lines in here, don't I? Okay, so what we're going to do is find a corrected balance for these.
It's 2115.
2115. So we'll see the corrected balance. And it should be the same on both sides. Yeah. So you came with the same on both sides? 2115.
Yeah, it's same on both the
The
sides.
same both sides.
Okay. So this is the true amount of cash we should have in that account. Okay, now, as was stated earlier, the banks, they're real jerks and they won't let us adjust their books. So we'll have to adjust our books to get this thing. So we will make journal entries for all of these. Because we need to get to our correct balance of $2,115. Okay, so let's see here, I'll put them on the screen behind me. There's a problem here. Because when I do this, I can't see the maybe I'll see if I can do them by memory. Okay, yeah, that's all right. Okay, so I can't see myself on the screen, so if I do something goofy, it's and I on the test, I'm not going to require you to do it, but this is kind of the idea behind it. So for that first one, we have receipts, so we'll probably have it look like this, the adjusting cash entries. Put a marker. So the first one looked like this. Our cash should be going up by 50. And we probably have something like revenue or something on the other side. So for each one of these, note collection, that would be cash, notes receivable, $500. So you get the idea. So for each one of those, each one of these, the 6 items, you would make the journal entries, and at the end of that, your balance would be on the books of 21. Just staying in the way of it. So for each one of those, you would do your, your journal entries, and that would adjust the cash. So for all 6 of those, you'd do those. And part of the reason why companies have to do their bank reconciliation is their cash will not be correct if they don't. Okay. Any question on that? All right. Well, let's go to the more tricky ones. What time is it? Okay. This is actually one. This came off of a. This is a CPA exam. All right. And by the way, the CPA exam was an open exam up until 1996. Which I know it was a long time ago, before some of you were born. But for things like bank reconciliation has been around for 100 years. So we actually have CPA questions that were actual CPA questions that were were available. When I took the CPA exam, they gave you the exam, and then they gave you an answer sheet. You filled out the answer sheet and turned that in, and you could put that exam in an envelope with a stamp on it, and they would mail it to you. You'd actually get the exam that you took. It was an open exam. All the questions were out there. So this is one of those. This comes off of those questions that it was a CPA exam question. Okay, come on, share the screen. Okay. And this is kind of a condensed bank reconciliation. This would have been the corrected balance per book, and they're showing this is basically the bank side of the bank reconciliation that we just did. This is basically this side. Okay. Now, we have these deposits in transit, we have outstanding checks. And so this is where it gets a little bit tricky. So let's take the deposits, the first one, the deposit in transit. Pretty generous on the spacing on these. Not sure why. Okay, so we have deposits in transit of 3,500. Now we come down here, and the company has made $8,400 in deposits, and the bank has collected $8,700 deposits. Okay, so notice 3,500 was put in at the end of the month. We deposited another 8,400 and the bank has collected 8,700. How much of the deposits are still in transit? And if you have it, yell it out. And I'll do it myself. So if you yell it out, I'll know what the answer is.
So can I say something?
Mhm.
Okay, we will take the deposit per book. We subtract deposit per bank and we add deposit in transit per reconciliation to get the deposit in transit.
That's correct. That's absolutely correct. I'm going to do it exactly like you said, in a little bit different order, but the same thing. You know, how much of deposit should we be collecting? Well, we had the 3,500 from before plus the 8,400 we have now.
We have to minus the bank balance.
Yep. Okay. Why is it doing this to me? I don't know how I got this. I got to reformat this thing. Okay, so yeah, so what is that? So 84.
It will be 11,900.
Okay, so
No,
no.
so we 3,200.
Yeah, it's the total.
Yes, that's true.
Okay, yeah, so this will be. So this equals 11,900. All right. I don't know what I did here. Let me try this again. I think I realized that this is probably just a bunch of this whole thing like that. I'm gonna do it down here. Okay. I could do it on the board, I guess. The deposit in transit. We will take the 3,500 that was in transit from the last period,
Mhm.
plus the deposits we made this period, 8,400. And that equals a total of 11,900. Now, if the bank had collected everything that we had out there, they would have collected 11,900. But they only collected 8,700. So oops. We're going to take that minus the bank deposits of 8,700. What did you say it was? 3,200?
200.
Okay, so 3,200. This will be our deposits in transit. Okay. We're gonna do the same thing with the outstanding checks, although I'm gonna be a little smarter and not, you know, goof it up, hopefully. Okay, so outstanding checks. So we wrote 9,200 of checks. We had 4,500 that were still outstanding, so we're gonna add those two together. we had 4,500. Oops, plus we wrote another 80. No, we did 9,200 of checks. What does that equal?
13,700.
13,700. Thank you.
13,700.
And then we're going to subtract out those checks that the bank received.
406. 4,600.
Without 600, is that with the outstanding checks?
Yes.
So 9,200 minus 9,100. Okay. So this will be our outstanding checks. We'll have, so this will be oops. Okay, now we can, oh. I'm just gonna copy these down here. So now we can do our bank reconciliation. So deposits in transit were 3,200. Outstanding checks was 4,600. And we don't forget this other stuff we have here. The note collected, the bank service charge, and the NSF check. Okay, so balance per bank was
25,740.
740.
Yes.
21,140. No, 27,140, 23,800.
25,740.
Professor, where did you get the bank balance? Yeah,
Which one?
it was 27.
Yeah, I goofed up. That's right, I got it. I made a mistake. Okay, so our deposits in transit. Was the 3,200. Our outstanding checks were 4,600. Oops. Oops. And the other stuff is note collected 2,500, service charge, and so 2,560, 500. I'll fill these in a second. Okay, so this is note collection. This is a service fee or something like that. Service charge and NSF. Now, okay, so then our corrected balance,
5,740.
how much is it?
25,740.
5,740. And hopefully it's on both sides.
Yes.
Okay, so this would be our corrected balance, and again, we would have, if this was the client, they'd have a little bit of work to do, they'd have to make journal entries for these. So this is one that you'd see on the, like I said, on the CPA exam. Let's go ahead and take a break, and if you want, you can, start working on the next one, we'll do the next one also, just because these are difficult, but let's say, be back at, what time is it? 7? Let's say be back at 7:10, how about? Okay. Okay, Kayed and Jinsey and Swati. Did I pronounce it? Okay, good. Okay, very good. Oh, absolutely. Yeah, absolutely. Yeah. Yeah, we'll take a break here. We'll go like 10-minute break. Okay, I think I'm gonna go over how to submit documents. And basically you can do it any number of ways. So let's go to week one. By the way, this going by the weeks thing was not my idea. This is they make us do this. But anyway, so the chapter 10 handout actually was handed out in week one, so that's why it's in week one. And the auditing overview we had last week is also there. But let's take this week chapter 10 handout. You're going to click on that, and you can do any number of ways to put it in there. You could do it in create a submission. Probably the one most people do is upload files. And there are unlimited number of files you can upload. And so what I mean by that is you could scan whatever you're doing, however you're doing this, you could scan it in if you have the handout. You could take pictures of it. If you're doing it on notebook paper, you could take pictures of the notebook paper and have those in. You can really put those in almost any way you can think of. So pictures are fine. If you want to just take a picture of your phone and put it in, that's fine too. The only it's not here. Hold on. The only thing that it will not take is, oops, give me 1 second. The only thing that's not allowed are the zip files and page files. It should take them, I agree, but it doesn't. So, but any way you want to get those in is fine with me. If you did it right in the handout, if you do, like I'm doing on screen here, that's fine too. Just save it, send it in. You don't have to put your name on it or anything. It'll automatically be in your account. Okay, I think I'm gonna let you guys do this one on your own, the second one.
Can we send
Which one?
for today and the last week, the overview also?
Yeah. Those are both the end. And then after today, hopefully we'll get done with it. We should get done with this today. I'll send out the exam, and all this is due in a week from Friday. So a week from tomorrow. You have over a week. Well, I should say, let's say about a week to turn it in. So the exam should be out by midnight tonight. I should have the exams out, emailed. But anyway, you'll have about a week to turn those in. So you have time to go over it.
What type of questions are there, like examples of questions in a exam? The similar one that we are doing now?
There's any ones like we do now, what we're doing now. There'll definitely be one like this on the test. Exactly like the like problems L and M will be on the test.
Okay.
And there will definitely be there won't be a lapping one on there. But there will be, and we will have multiple choice questions, which I'm going to go over in a little bit here. That
Okay.
will be similar to what will be on there. Okay, I'm going to jump ahead though to the bank confirmation, and when you come back, I'll stick around and we'll fill this one in later on. But I just wanted to go over a few more things. The bank standard reconciliation form, or standard confirmation form. This is not a bank statement. Now, it will have the ending balance. Oops. So it will have the ending balance for each account. It does not have any transactions. So you will not find any outstanding checks or deposits in transit or deposits for the period or any of that in there. So a standard bank confirmation just says For instance, here's the account. Here's how much the balances are in those accounts, and that's it.
Can you come down, please?
And probably the most important thing it has on there, it will have all loan agreements should be on there with that bank anyways. So those loan agreements may have minimum balances. Collateral. Interest amounts. Et cetera. So anything that has to do with that account will be in there. So these are important because, for example, and by the way, most banks require you to do all your banking with them if you have a loan through them. They don't want you going out and getting a bunch of loans from a bunch of different people, and all of a sudden they're standing in line with 30 different lenders. But one of the important things is, like, for instance, it states the interest rate. So you can check to see the interest expense if the interest expense is correct based on the interest rate the bank gives. If you have a $10,000 loan and it has a 5% interest, well, it's really easy to calculate what their interest expense should be. So part of the bank confirmation is, it does have the ending balances on it. It doesn't have any transactions, so it's not going to help us like with the bank reconciliation. But it generally has all the loan agreements and all the anything that has to do with the accounts that they do have, and oftentimes they'll have all. My et cetera is wrong, is it? Yeah, so it's an important statement because of usually the information it gives you on the loans. Okay, all right, so let me get a little spacing in here. Okay, which of the following can be verified by a standard bank confirmation?
Is it C?
Yeah, actually, it's a number of these. It will tell you the loan agreements. Yes, it will. It will see the ending bank balances will be on there too. The only one that's not on there is, I should probably ask this differently, which the following cannot be verified, because all these things will be on there. Who wrote this question anyway? So the daily bank account activities, you don't know those. It's just at the end of the period, but it will tell you the loan agreements, the collateral, the ending bank balances will all be on there. Oops. Let's do like this. Okay, which of the following can be verified by a cutoff bank statement? This should have been up with the other one. I think I just did it for spacing.
It's A.
Is it on
Yeah.
recording?
Yeah, it's actually gonna be all of them.
All.
Yep. And we haven't done kiting yet, but it will be in there. All of these, yeah. So truthfully, all of the, it'll find deposit and transits, verify that those were, so for instance, this 3,200 of bank deposits and transits, you should be able to look at the cutoff bank statement and see that 3,200 come through. Right. I mean, 10 whatever days into the period, you should be able to see those. Unrecorded liabilities, payments made that are not on the books, but you've made a payment for them in early January. They probably should have been on the books usually. Could have been something that came up in January, and kiting, which we'll cover next. Okay. I am going to skip this one. This will not be on the test. I will tell you basically what it is. You're basically just trying to see which of these checks were, which of them cleared the following period. This is what you'd go through for instance, making of the bank reconciliation to see what checks were outstanding. Okay. I think this is the last topic, isn't it? Yes, good. Bank transfers. So this is when you transfer from one bank to another. Now, so it could be from one account to another account in the same bank, but usually for a kiting example, it's going to be from one bank to another bank. So you have bank A, you'll have some kind of a cash account in there, and then you'll have bank B. And you have some kind of a cash account there. It's possible they're in the same bank, and usually they will be, but it is also possible that you will have them in two separate banks. Okay, so it's transferring cash from one bank to another. That's what we're talking about. We talk about bank transfers. It could be in the same bank from one account to another, and it could be also from one bank to another. For kiting, it virtually has to be from one bank to another. So when they transfer this money, and it could be for a number of reasons they transfer money from one to the other, but there is a possibility of kiting, and the possibility of kiting comes about because of this. If you write a check from bank A and deposit it in bank B, bank B is going to recognize it probably pretty quickly. And until the check clears, bank A won't know about it until it goes through the checking system. So it's much faster nowadays usually, but if you make a deposit from one bank account to another, it's going to take some time before that bank that you wrote it on is going to know. So if you are a fraudster, which is the best word in the English language, if you're a fraudster, what you could do is make it look like you have more cash than you actually have. You could deposit $10,000 into this bank over here, not record the transaction. Magically, $10,000 will show up on the books. Now, in a few days, it'll work itself out, but at least at year end, it'll look like there's $10,000 extra in that bank account. And that's because there's a timing difference between when you write the check and when it actually clears and comes back to bank A and says, oh, we wrote a check, by the way, to this other bank. So that's what kiting is up. That's the whole idea behind it, is that it can make it look like you have much more cash than you do. And notice when you do that, one of the things they always say, well, what's the cash? What's the cash? You can't, cash is what actually happens. It's very hard to argue with somebody if they say they have a $10,000 purchase at year end. You go, well, of course they do. Look, and this is cash. Look, there's $10,000 of cash. This is an actual cash payment. We're not just making this up. It makes it a very sort of a credible kind of a fraud. Okay, so you're really sick, yeah. I don't want you falling over here. Okay, so kiting. I will, me too. Writing a check from one bank and depositing it in another.
We don't see anything.
You're right. You see my big head. All right. Writing a check from one bank and depositing it in another. Um, oops. I don't know. That's not very good writing. My wife was a English professor. And she would cringe if she saw what I was putting up here in front of you people. It's writing a check from one bank and depositing it in another, and it's to make it appear that the client has more cash than they actually have. So it's just to make it look like they have more cash than they do, and it could be used to make for instance, make their sales look more profitable, make them look more profitable for to get a bank loan or something along those lines also. Okay, now for a valid bank transfer, there are two criteria that we generally look at. The first one is the journal entry was made on the same date or before. So same date or before the deposit is received by the bank. So when we make the deposit, there needs to be a journal entry made. The journal entry for the deposit and the receipt must be made on the same date. So the journal entry not only has to be made at the same time or even before, but it has to be both the receipt and disbursement have to be made on the same date. And the first one here is this is how a bank transfer should look. The first one here has no problems. And let's go through the rules though. Okay, so they made a deposit into Bank A from Bank B. It was received on 12/31. Okay, notice that the journal entry is on 12/31, so it's on the same date, right? For whatever reason, they said we need to make this okay, so it's okay for the first one. And the journal
no.
entry, yeah,
Because the disbursement is made on January 4th.
right. So the other bank, the bank that was written on doesn't know until the dispersed on the 4th, but the receiving bank, so the receiving bank got it on make that green. So this is the receiving bank. They got it on 12/31. And the journal entry was made on 12/31. So it satisfies this first criteria. So this one's okay. We go to the second one. The journal entry for the deposit and the receipt must be made on the same date. Well, they are. They should be made in the same journal entry, and that's what this one is. So it's just a cash to cash. You know, you're not any better off or worse off than you were. So it's made on the same. They're made at the same time, and it's made on. And in this case, it's made on the same date. So this one, would there be? Is there a problem with the transfer? No.
No.
Yep. There's no problem because it follows the two rules. It has to be made at on the same date as the deposit or before, and they both have to be made on the same date. Okay, let's go to number 2. I can't remember how I did the spacing on the actual printed handout. And there is no problem, so we're not going to say why, because there isn't any. Okay, so let's go to the next one. So the receiving bank got it on
Put the answer why. They follow the same rule. Why? You have to put the answer.
this one. There is
Yeah.
yeah. So that there is no reason why it is there a problem? No, there isn't a reason why. It followed, but well, I guess we could say that. Why is it okay? We could say that it's made on the same date. Same
We
date.
can write that it meet the both requirement like the criteria.
Yeah. So it meets both requirements. Good, thank you. That is a much better way of saying it. Okay, let's go to number 2. Now, number 2, the receiving bank got it on the 2nd. The journal entry, I'm gonna pull these. The journal entry is on 12/31. So does it meet the first requirement? The journal entry is made on the same date or before the deposit by the receiving bank.
No. Because it's the 31st and the January 1st. Sometimes January 2nd and January 1st it should be the same.
Well,
It-
it's actually made before. So this one is actually okay. This would be a before.
Same day before, not after. Okay.
Yeah, and here's why. It might be that when we deposit it in the bank at the end of the day, they don't count it at the end of the day. You know, they may receive it, the following business day or whatever. If this is at month end, you deposit it on 12/31. Well, the bank might not count that as being received until the following day. But the journal entry is made here. It's made no, not on the same day, but before, so that's fine. And are the receiving bank and disbursing bank, are they made at the same time?
Yes.
Yep, so there's no problem with this one either. This one's fine too. Nope, and for the same reason as before. It meets both requirements. So this is what we want to see for a bank transfer. That's what a good bank transfer is. Now, you're probably wondering, what's a bad looking one look like? Okay. Let's look at number 3.
There is no problem.
Problem.
There is a,
Because the journal is after, not before.
yes. So here's what's going to happen when this goes through. Let me crazy amount of okay. Yeah, so I'll show you up here what's going on with this. This is going to look like magic money showing up in the bank account. It's going to show just that quick, I forgot how much was in there. $12,000. It's going to show magically that $12,000 appears in this bank. There's not going to be any record of it. It's just going to show up in the bank. So that $12,000, when it shows up in the bank, there's not gonna be any journal entry that shows, why that they showed up there. And, the problem is they may even make a journal entry that, in this case they didn't, but they could even make a journal entry that shows that as being a revenue. But in this case, it could be, maybe they stole $12,000 out of it or something, that they're trying to cover up. It'll look like it magically appeared. And they didn't record it, so you can't, what am I doing here? That's not it. Here we go. Now, it does meet the second requirement. These two are made at the same time, but
Yes.
but it fails on the first one. There's a problem with this transfer? Yes.
Yes.
This will overstate cash by. So this fails requirement 1. And this will overstate cash. It'll look like there's too much cash in there, more cash than there really is.
The same day, yes.
Okay, now number 4 is a full-blown cooking the books. That's what we like to see. Okay. So, receiving date is that. And we actually have 2 dates for,
The second date not correct. The second date expense is made after the receiving.
exactly. So it fails on the first one. It's made the second half of it, basically the dispersing is made after it. And they're not made on the same date. They're not made at the same time. These are made at 2 different times. So the dispersing and receiving bank, they're made at 2 different times. So this fails both. And this is a classic one when they're trying to make their books look better than they really are.
But both criteria.
Yep. And this will overstate cash, oops, and revenues. We notice this journal entry, they put cash and revenues. And, as an auditor, you always look for the cash and they say, well, of course, that's a true sale. Look, we even, there's a cash deposit for it. How can you argue with cash? Well, it was written on, if it's one of their own checks, is obviously not really a revenue. So this would overstate cash and revenues. And then you notice in the second, you go, okay, what happens to the other part? Well, the next, and then going into the next year, they have to come up with something for the disbursement, and maybe they say it's an expense or something along those lines. And this is kind of shifting from one year to another. I mean, you're gonna have to do something in the following year to cover up for that other expense. But the idea is that this is a classic kind of cooking the books using kiting. It's a lot harder to do kiting now. It's a lot more electronic now. Okay. Well, let's do the multiple choice questions. Well, we'll kind of do these together. I'll send them out. Let me see if I can. I'll put them on the screen too. Hey, what did I do with them? Uh-oh. Okay, I'm gonna send you through the email. I'm also gonna pass it to the class here. I think we'll just do these together. Okay, let me see. Oh, I know, to show you guys a 4-column bank statement. Uh, for instance, that first problem that we did, this is what it would look like as a proof of cash. I'll send this out to you guys. It's not going to be on the test, but if you want to take a look at it, this is what they kind of used in the textbook on, I think it's problem 49. We could do the same thing with what we did in class, but there's nothing, it's just a different kind of format for it. I'll send that out later. Okay, so did you guys at online, did you guys get the multiple choice questions?
We do. I do.
Yes.
Okay. Okay, so these are some of these same questions will show up on the exam. So the first one, what procedure would the auditor most likely use to detect a check outstanding at year end that was not recorded as outstanding at year end, bank reconciliation? So they made a check, they made the check look like it was outstanding that was not recorded. They didn't record the check. How are you going to find it? Now notice the bank reconciliation will look fine. That's probably why they didn't record it. So how are you going to find it?
Receive the cutoff
Yep, good.
from the bank.
Yeah, it'll show up here. You know, if they wrote the check but didn't record it, well, it should probably show up within a couple weeks of year end. So, yeah. So cut off bank statement. An auditor may obtain information on the December 31st month end balance per bank in which of the following?
The C seemed to be great. Yes, yes.
Yes, yes, you're right. And here's why. Because it'll obviously be on the standard bank confirmation form that have the ending balance. On the January 1st cutoff bank statement, the beginning balance will be the same as the ending balance on, say, December 31st. So the beginning balance on January 1st will be the same as the cutoff on the 31st. And now for the hardest of them all.
Entry A.
The A.
Okay, let's see. It was recorded at the same time or before. And it recorded on the books the same. So A is okay.
Entry B.
B, okay, recorded on the books. Yeah, these are at two different dates. So B is gonna be the problem. Let's go through all of them just to make sure. Yeah. And this one was done in a completely different period. So B is correct. B, or as I like to call it, B. Okay. Which of the following manipulations of cash transaction would overstate cash on the balance, the cash balance on the financial statements?
Understatement of deposit in transit.
Well, okay, let's go to the, oh wait, I don't have the bank, what am I doing? I thought I'd go up in the bank reconciliation. Let's go to the bank reconciliation here. Okay, so if we understated the deposit in transit, that would make this actually lower. I'm sorry, one more time? Yep. Yeah, if we understated the outstanding checks, that would reduce the amount that would be subtracted out. So this would overstate the cash. And overstatement of bank service charges would reduce the cash too. So these other ones would reduce the cash. That's a tricky one. All right, Jones embezzled $10,000 from his company account in Bank A. At year end, he hid the shortage by making a deposit on December 31st in Bank A drawn on Bank B. He has not recorded the transaction on the books. This is an example of,
Eating.
yeah. I was going to say effective cash management, but you know. Okay, very good. I'll give you guys extra credit points for those. So here's what's going to be on the test. On the test, you're going to get one bank reconciliation. I'll send out the solution to bank reconciliation to for M. I'll also send out the proof of cash. Proof of cash will not be on there, but the bank reconciliation. So you'll get one like L and M. You'll get a kiting example. Oops. Not that. Kiting example. And I think that's it for the problems. Let me check and make sure I'm not lying to you. And multiple choice questions, similar to what we just did. So those will be on the test, and I'll have that out hopefully by like midnight tonight. I'll get it out by. But yeah. So any question on that? And don't forget the what? The sampling. The sampling and it's just the two-page sampling one. I know I sent out like a 10-page one earlier, but the 2-page sampling one, and there's a video on it. The video is I think like 15 or 20 minutes or something like that, and you'll probably catch on to it pretty quickly. But anyway, so if you take a look at that and turn that in, so turn
Do you
it-
want us to send back also the multiplication question?
the which one?
The multiplication we just do also.
Well, yeah, we'll let me see here.
Do we have the sampling one or no? The basic.
Oh, the sampling one will not be on the test.
Okay.
That's an excellent question. The sampling one, let me get back to my Zoom thing here. The sampling one is going to be a separate exam.
Okay.
So, and the sampling one will have a, there's gonna be another type of sampling in it, and then we'll have a review for it, and then we'll have the sampling exam.
So we will do next week.
The sampling exam will not be until near the end of the term. It'll probably be like week 15, maybe.
Okay.
And, and again, for all these exams, you get about a week. So, you'll have some time to get them in. Okay, so anyway, I'll send out the exam tonight. It'll be due a week from tomorrow, so you'll have a week. And by the way, next class, you can also ask me questions on it if you have any. I won't be able to give you the answers or anything like that, but I can answer any questions you may have if it's vague. Okay.
Do you have also to send the multiple question we just did?
Did you get it or no?
We got it. We wanted to send you back.
Oh, I'm just going to add, I'm going to take it from the attendance on the Zoom meeting. And I will give you guys extra credit points for the multiple choice.
Okay.
So we just need to, we have to just submit the chapter 10 handouts.
The chapter 10 handout, the
Overview.
the overview, and then the sampling, and then I'm also going to send out the exam.
Okay.
Yep.
We don't have to send chapter 11, right?
The multiple choice don't have to send. Okay, well, have a good evening, and I will get you those exams as soon as I can.
Okay, thank you.
See you guys.
Thank you.
Good night.